Let's connect to Ashwin Agarwal, founder with Demeter Advisors. Let's connect with him. It's been a while. We haven't had his market view. Ashwini, fantastic to have you back. Thank you for joining us. I heard there was a big market gathering outside India where you were invited. And I've seen pictures of you from there.
No. I think you're mistaken. I don't think I was there.
Yeah?
But no.
You know which event I'm talking about?
Yes.
Okay.
I think so.
We shall talk offline.
Yes.
Okay. Markets, meanwhile, what do you make of it? Do you think that this time is time where markets could consolidate a bit more? They will only go higher after elections?
So, Nikunj, the economy is doing really well, and if you look at the earnings, they seem to be quite constructive. Apart from, let's say, the IT services pack, and in select pockets, we've seen a meaningful consolidation. Financials is a case in point where, among the private banks and among a whole bunch of NBFCs, we've seen a fair bit of consolidation. So I think if there are no surprises in the elections and there are no big surprises in the budget, I would expect that the underlying strength in the market that we've seen over the last year or so continues for the next couple of years. Having said this, I'd again like to draw attention to the fact that this is possibly the longest stretch of low volatility that we have seen in the market. I mean, since the start of COVID, we've had maybe just two or three corrections which are, in double digit, and both of them were like early teens, mid teens. And if you go back in history and see the longer term trajectory of the market, it's very unnatural. I mean, typically, through the noughties, which is 2000 to 2010 period, I mean, we would see a 10% correction, every quarter, and every year we would see a correction closer to 20%. But volatility has simply gone away, and that's gone away for a variety of reasons, which include liquidity and lack of alternatives for investors. But my sense is that with inflation being on the higher side and being persistent, and I don't see how that will change, we should see volatility inch up and stay at higher levels. So I think expecting some correction on the way or along the way is probably quite natural. And I think that's the only thing, I would caution against. So if you have a longer term, medium term view, you're fine. But if you're looking to trade, then, just be careful.
So, Ashwini, what should be the strategy right now? Those who are looking at it a little bit more tactically, because, this entire year you've got news flow thick and fast. You've got our domestic elections. You've got the US elections as well. For India, not just earnings and a lot of, churn out there, but even the fact that FIIs continue to elude India markets, and there is data and evidence that it's actually money moving to markets like China, for whatever may be the reason. So would you say that take some profits off the table, or is it more like a serious capital protection mode?
It depends, Aisha. The answers depends upon which investor you're speaking with. So like I said, if you're a mutual fund investor and you are, let's say, in your mid 30s or early 40s, and you're looking at a corpus that will help you at the time of retirement, my advice would be do nothing. If you are a trader and you are looking for absolute returns and you want to protect the downside, I mean, look at either raising your cash in the portfolio or look at hedging strategies. Uh, We've got a couple of big events from the Indian context coming up. One is obviously the election result, and the second is the budget post the elections. Last week, the market was abuzz with the capital gains tax rumors. And to be fair, the finance minister and the other officials in the finance secretariat have been quite vocal, saying that there are multiple ways capital gains tax are levied. There are different definitions for long-term, short-term across asset categories, and we would like to see a rationalization. Now, what that rationalization brings is anybody's guess, but on the face of it, it may not be good news, for markets. So, that's something that has to be seen. Having said that, before that, we have to see the election results. I mean, the given case is that the current administration will be back in power, and let's see how that turns out. I mean, there's nothing to suggest otherwise, but it still is something to be seen. So I think those are the two events that I would watch out for. Foreign investors staying away. is probably driven by valuations. I mean, Indian valuations are expensive in the emerging markets context, even though the term emerging markets has lost a lot of relevance of late. But compared to China, obviously the valuation differentials are very glaring. I mean, in China, you can find several stocks where dividend yields are greater than P numbers. So, say what you will about the political environment there or uncertainties there, at some point in time, the valuations become very, very attractive. And that's exactly what the Chinese market is telling us. I mean, it's like, PSUs in India in 2020. I mean, I'll speak about a stock, Indian Bank. The results came out yesterday. I don't own it. But I mean, the stock was trading at whatever, 140, 130 2 years ago, which is like, in hindsight, at 2 times March 24 earnings. I mean, it was ridiculously cheap. So I think several stocks in China have gotten to that level. So that's why I think foreign investors at the margin might be more interested in China than they are in India at this point.
Those who bought PSU stocks in 2020, they've been rewarded. And if the idea is that China is attractive and cheap, then if money is moving there, then you never know, that money may just continue to move into China at the cost of India.
Yeah, that can happen. But Nikunj, let's also look at, what the domestic investor flows are. I mean, domestic investor flows in mutual funds alone are a little over $2 billion on a per month basis, on a run rate basis. In addition to that, you have large family offices and you have individual investors, and there's a whole bunch of data, and you have the data better than I do in terms of new folios and so on and so forth. So I think the domestic investor is quite excited and is not going to back away. I think the lesson, which is the result of low volatility and the kind of unidirectional move we've seen in the market since COVID, that people have learned is that, it's best to stay put and not trade around too much, especially the retail investors, the mutual fund investors, and that has paid off extremely well. And I think, therefore, the domestic investor will continue to drive the market. Now, foreigners at the margin may turn net sellers. You might have a year, of consolidation, like you saw in 2022, for example, when foreign investors were net sellers. You did see the market consolidate, and that might happen. And that will be healthy for the market, given how sharp the run-up has been over the last 1 year. Allow the earnings to catch up, allow valuations to become a little more reasonable. I mean, that would be a good thing to happen, in my view, not a bad thing to happen.
There seems to be a sudden excitement in rural denominated sectors. Two-wheelers have done well. Numbers and dispatch numbers have been strong. Commentary from Britannia yesterday, what we understand from Dabur. That part of market, which in a sense was like the slow end, now seems to be turning around. Do you think there is money to be made in this entire rural comeback theme, whether it is autos or select FMCG?
I hope so. I mean, rural demand has been very weak for almost 3 years now. And rural demand hasn't really come back to what it used to be after COVID. I think there was a lot of disruption in the rural disposable income on account of the disruption in jobs in the urban area on a post-COVID basis. But I think with manufacturing picking up, several of those jobs are coming back, and those transfers from urban to rural India might be getting back. The prognosis for the monsoons also is pretty positive this year, and food prices are also relatively strong. So I hope the rural demand picks up. I mean, it's been a big monkey on the back of a lot of consumer companies, including autos and consumer staples companies. So I hope rural demand comes back. My base case would be that yes, it comes back.
Okay.
Sure. Ashwini, what about banks? Because, much of the same story is kind of playing out. Private banks are just all over the place, and I'm not talking about a standalone HDFC Bank here. You've got that RBI ban coming in on Kotak as well. Bajaj Finance also was also in the news, and I'm only widening the net here. What are you safer right now in? Is it PSBs, or is it still the private financiers and the private banking lot?
Very interesting question, and I've been, devoting a lot of time into this space, especially because the NBFCs in particular have corrected a lot over the last 6 months. If you see the results, they are showing you a very clear pattern. Everybody's talking about good growth in loans. Everybody's talking about margins being stable to slightly under pressure, and credit costs having bottomed out. And for the private sector, they don't see any tailwind from credit costs going down further. But in public sector banks, you still see scope for write back. So that's the broad narrative. So in this narrative, what do you look at? I think that, if you can find stocks which are trading at median or below median from a long-term historical basis, where you have confidence in the management's ability to not make mistakes from a regulatory standpoint or from a customer or credit risk standpoint, this might be a rewarding area to invest in from the next 1 year perspective. And I think the relative underperformance of private sector banks versus PSBs has by and large captured the extreme valuation differentials that we saw between these two cohorts over the last couple of years. So now I think it's a more of a bottom-up exercise. You could find a winner in a private sector bank, you could find it in a PSU, you could find it in the NBFCs. But my recommendation or my sense is that the returns that we are looking at are probably of the order of about 20 to 25% on a 1 year out basis, if we get the stock picking right on a bottom up basis in this space.
So you're saying it's about stocks, it's not about any kind of market cap classification or private and PSUs.
Yeah. I think the valuation differentials have now disappeared, and now I think it's purely a bottom up exercise in the financial space overall.
Ashwini, so if one looks at the market actually has not given you any great returns this year. 4-5% is what the Nifty has done. And this market has got enough and more in terms of ammunition. Fed in a sense has not disturbed the market. The political narrative is something markets are enjoying. Growth and GST collection, that also has been the right side. So with so many triggers, if markets are really not flying, then what really could be the next trigger which will inject the next level of excitement?
Because my sense is that Nifty kind of doesn't capture the market mood, principally because there are a few very large stocks that determine the Nifty's movement. But if you look beyond those handful of 5-7 names, then I think the story might be different. Speaking of Nifty, I mean, you look at the top 10 names, right? You have Infosys, you have Hindustan Lever, you have a bunch of these stocks where I think earnings are kind of so struggling, not really painting a very exciting picture. And then you have HDFC Bank, a position I own for due disclosure, but we are not discussing the stock here. But all I'm trying to say is that the heavyweights don't have a lot of tailwind to them. Okay, but the moment you dig slightly deeper, go to the next 100, go to the next 250 or the next 500, I think the stories are very interesting. And I'm not talking about defense or I'm not talking about railways. I'm talking about a lot of simple homegrown industrials, homegrown export companies, people who've got their cost equation right, people who've suffered higher or volatility in raw material prices, or volatility in shipping rates over the last 2 to 3 years, for whom business has normalized and valuations are not expensive in this space. I still am able to find companies which are trading at 10, 12 times 1 year out earnings, growing their earnings at 20%. And I think that's where one should be focused on. And I think the next 3 to 4 years, unless India's economic growth or macro stability takes a beating for some reason that we can't forecast right now, India will remain a bottom-up market and a fairly rewarding market on a bottom-up basis.
And morning, Ashwini, when it comes to the entire earnings, do you believe that by and large it's going to be pretty much in line and that IT services is going to be the only disappointment, or are there any other sectors?
I mean, so far, if you look at the earnings season, I mean, the disappointment has largely been in the IT services sectors. By and large, the others are meeting expectations, or in the smaller mid-cap space, some stocks are even able to exceed expectations. So I think the earnings season, by and large, I would say, at least that's my impression right now. We'll see at the end of the season how the data plays itself out. By and large, is in line with expectations, with sort of disappointing to marginally in line for the large caps, and in line to slightly better than expected in the mid and the small cap space. That's how I would put it.
So Ashwin, you would advise our viewers that if you're in for long haul, 3-5 years, don't worry whether it's election or budget, just stay invested.
Absolutely. But I would also say that given how stable and how unidirectional the market has been for the last 1 year, it is not out of place to expect a 15-18% type of a correction. What it will be led by, I can't say. There are events on the horizon which could turn out against us. There could be something completely out of the left field. But just looking at the history of the markets and how volatility tends to play itself out, a correction is something that's possible, but just kind of hold tight and sail through it from the point of view of retail long-term mutual fund investors. And for people who are looking at absolute returns and creating wealth on a bottom-up basis, I would say, go to the lower end of your equity allocation. That would be my recommendation.
Right. Okay, Ashwini, great to have you on the show. Thanks as always for taking the time out.
Thank you.
Okay, let me just.
If you like this video, then like, share and subscribe to ET Now.